How is everyone doing today? Welcome back to another episode of the Banker Next Door. I'm your host, Dr. Joe Berquist. So today we're going to be taking a look at the OCC second quarter for 2025 report on banking, trading activity, and derivatives. So one of my one of my favorite reports to look at. Again, this is a very short report. It's only about 11 or 12 pages long. So not, kind of gets right to the point and gets right to it. But what I want to share with you guys is basically we're going to look at this press release from the OCC real quick, and then we're going to look at the report itself. And I will remind everyone there are links to both the press release and the report down in the description down below if you would like to go take a look at them. But let's jump into this press release real quick. So OCC reports second quarter 2025 bank trading revenue. So the OCC reported cumulative trading revenue of U.S. commercial banks and savings associations of $16.6 billion in the second quarter of 2025. The second quarter trading revenue was $1.6 billion, or 10.7% more than in the previous quarter, and $355 million, or 2.2% more than a year earlier. In the report, which is titled Quarterly Report on Bank Trading and Derivatives Activities, the OCC also reported that as of the second quarter of 2025, a total of 1,217 insured U.S. national and state commercial banks and savings associations held derivatives. Now, remember, there's over about 4,600 banks in the U.S., so only about 1,217 of them actually are holding derivatives. Four large banks held, basically the four largest banks, the big four, basically held 87.3% of the total banking industry notional amount of derivatives. And most of those are based in credit default swaps, and we'll see that in just a few minutes here. Initial credit exposure from derivatives before netting increased in the second quarter of 2025 compared with the first quarter of 2025. Net current credit exposure increased $18.8 billion, or 7.6%, to $267 billion. Derivative notional amounts increased in the second quarter of 2025 by $13.1 trillion, or 6.2%, to $223.5 trillion. Let me say that again. Derivative notional amounts increased in the second quarter of 2025 by 13.1 trillion with a T, or 6.2%, to a total of $223.5 trillion. Yes, the amount of derivatives out there is just absolutely mind-blowing. Derivative contracts remain concentrated in interest rate products, which totaled 148.7 trillion, or 66.5% of total derivative notional amounts. Yeah, absolutely amazing. But this is also why I like, looking at this report. So here's the report itself. I'm going to blow this up so that everybody can get a better look at this. Quarterly report on bank trading and derivatives activities, second quarter 2025. Now, here's the contents. It just has a quick about this report. It has an executive summary, talks about the revenue from trading activities, counterparty credit risk, and then it gets into the market risk, which is basically the derivatives. And then at the end on page 14, it has a great glossary of terms, which is really nice. So anybody looking at this for the first time, any high school or college students, hopefully watching this or looking at this for the first time, you can look at a lot of these glossary terms and figure out what a lot of these uber complicated things are. And then it has an index of an appendix with an index of tables and figures. So there's definitely some good gems to be found in there from time to time. So, and I'm not going to go through this whole about this. We already kind of got the gist of the executive summary. I just want to tell you guys the revenue. So insured U.S. Commercial Bank Savings Association trading revenue. So insured U.S. Commercial Banks and Savings Association reported $16.6 billion in trading revenue in the second quarter of 2025, $1.6 billion more, or 10.7% than in the previous quarter, and $355 million more, 2.2% than a year earlier. See Table 1, which is right below here. The quarter-over-quarter increase in trading revenue was due to increases in revenue from foreign exchange, equity, and credit. For a historical view of quarterly bank trading revenue by instrument, see Figure 14A in the appendix. Like I said, there are some gems in the appendix from time to time. So again, what are the trading instruments we see here? Well, we get interest rate, foreign exchange, equity, commodity, and other, and credit. And then it goes into holding company trading revenue, bank trading revenue as a percentage of consolidated holding company trading revenue. We're not going to get into all that. Counterparty credit risk. So counterparty credit risk is a significant risk in bank derivatives trading activities. The notional amount of a derivative contract is a reference amount that determines contractual payments, but it is not generally not the amount at risk. The credit risk is a derivative contract is a function of several variables, such as whether counterparties exchange notional principal, the volatility of the underlying market factors, in other words, interest rate, currency, commodity, equity, or corporate reference entity, the maturity and liquidity of the contract, and the counterparty's credit worthiness. Credit risk in derivatives differs from credit risks and loans due to the more uncertain nature of the potential credit exposure. Because of the credit exposure is a function of movements in market factors, banks do not know and can only estimate how much the value of the derivative contract might be at various points in the future. So again, it's very interesting. If you go back, if you ever get a chance, go back, you could go to some of the interviews I did with Chatham Financial. I did a couple interviews with Bob from Chatham and an interview with Jason. But they're all about derivatives. We talk about derivatives. We talk about derivative instruments, plain vanilla, what is called a plain vanilla derivatives contract. We go through an example, how it works. So if you have any interest, you can go back. I even put a link to that, to one of those interviews in the end card here on the end of this, if you want to go click on those and check one of those out. But great videos if you want to just try to get a general understanding of how a plain vanilla derivatives contract works. So, but again, banks do not know and can only estimate how much the value of the derivative contract might be at various points in the future. So now let's go down here. I want to keep going here because I want to get to the big thing. We're going to come. Okay, market risk, and then we hit like value at risk, volatility index. So you can see here from figure 3, the volatility index, or the VIX. Again, this is a more general, just looking at market volatility. It's also known as the fear index. What is the fear in the market at any given time? And you can see here that fear did spike up a little bit here in June, but has settled down a little bit since then. We had another spike up around, June of big spike up, obviously in 2020 because of the pandemic. And then going back here, then this is the big to the far left here. This is the financial crisis, 07, 08, 09. Let's see here. And then we get into level 3 trading assets. Now look at figure 4 here, level 3 trading assets in billions of dollars. Now, interesting to note here, the fourth quarter of 2008, notice we were at the peak here, 204, billions up here at the peak of the second quarter too. And now we're all the way down to about 36 billion. So this leverage in certain respects has come way, way down. And then we get into notional amounts of all derivatives contracts. So right here, so again, $223 trillion in notional amounts of derivatives contracts. And those are made up of multiple different trading instruments, including interest rate, FX, which is currency, equity, commodity, and others, and then credit derivatives. You also have derivative notional amounts by contract type. Which is basically futures and forwards, swaps, options, and credit derivatives are the 4 different type of contract types. And then we get here, and now I think this is the interesting one here, figure 5, credit derivative composition in billions of dollars. So we have here, obviously you can see the bulk here is in credit default swaps on the left. And then we also have, then the next biggest would be credit options. Then we have total return swaps, and then the smallest one is other credit derivatives. But the vast majority, you see here is basically in that credit default swap, subcategory, category here. And then we go over here to investment grades, basically up to 5 years, so investment grades of 1 to 5 years is where the bulk of these contracts are invested in. And then the rest of them are all kind of in less than, 5 year, contracts. And then I think that was about it. I think that was all. Yep. And then we just get down to the glossary terms. So I just wanted to, again, I'd like to do this just to give everybody a quick overview. So we see here that bank trading revenues are doing very well at the moment. Credit derivatives contracts have continued to grow, $223 trillion, continue to roll there. Now, and again, I think that the derivatives market is a fascinating one because there's a huge amount of risk there, and yet but a lot of it is it's very interesting because a lot of it is very bland stuff that generally is just going to function as a good contract. It's going to run its course. It's going to make you a little bit of money, help you hedge certain things, interest rate risk, loan credit risk, number of different factors there. But at the end of the day, though, there is still a huge amount of risk in this, and it's like Warren Buffett basically famously described derivatives as weapons of mass destruction, and it was during the 07-08 financial crisis that we got a really big taste of that. So again, it's not without risks, and this is why I like to keep an eye on this. I like to look at this report just to get an idea of what's going on. Hopefully again, people found this a little bit informative. But with that being said, I will wrap up this episode by saying if you like the episode, please make sure to like, share, and subscribe, as that always helps the channel. Remember, we are on YouTube, Rumble, and all major podcast platforms. Please be sure to leave your comments down below, as I always love getting back to everybody. And as always, make sure to check out some of the other content on the channel. I thank you for listening. Have a great day out there, and I will see everyone again real soon.